It's helpful in those moments to have someone that stands next to you and says like, hey, we're here and we believe in you and, we're going to keep fighting. I think there's nothing you can do that will leave a more lasting impression than to tell someone you believe in them when everyone else doesn't.
Today, I'm super excited to sit down with Ernie Garcia Jr., co-founder and CEO of Carvana, the auto retailing powerhouse that has redefined online car sales. We explore the company's meteoric rise, dramatic challenges, and remarkable resurgence, plus get an exclusive look at how Garcia stayed true to his mission even when stock prices hit rock bottom. For those that know my background, this was a super special episode for me, jam-packed with lots of insights, and I hope you enjoy it. A big thank you to our sponsors for making today's episode possible. Deal Now, my very own CDG Recruiting, and Effective. And now let's get into the show. Ernie Garcia on the Car Dealership Guy podcast. Ernie, welcome.
Thank you. Appreciate it. Thanks for having us.
Thanks for coming on. We finally did it. We've been trying to make this happen for quite a while. Or I've been trying to.
This is my first real podcast setup too. So I've never had like the headphones and the mic. It feels very official, very exciting.
Yeah. I mean, I know you've done audio only. Where are you right now? In your office?
Yeah, we're in Phoenix.
How are you feeling nowadays?
Good. Probably the most interesting answer to that question is less different than you might imagine. I think, things are rarely as good as they seem or as bad as they seem. And so I think, in the days heading, into our troubles in 22 and 23, it probably wasn't feeling quite as good as people imagined. I think in the depths of 22 and 23, it was no fun. There's no question about that, but it probably wasn't quite as bad as people imagined. And today, I think we're trying to keep it level as well. So feeling good, but probably not as different as you might imagine.
Did you believe that you could recover? And I say that, again, this is for context for those that don't follow the public markets that closely. This is your recovery as a company has been historic. You have a very long road ahead of you. You speak about this a lot, but seeing so many drawdowns to your stock price, taking a 99% hit, and it's not at once, right? This is like week and week and week, and it was a really tough time. Did you truly believe within yourself, or was it sort of this like cognitive dissonance where you just say, I'm just going to keep going and whatever happens? What went through your brain?
I mean, I'll say, as an entrepreneur, I think you're always inclined to believe that you can figure things out. And so certainly that's where I was personally. I think that's where the whole team was. I think the time that I was most nervous is, there's inside the company, there's a lot of people that care a lot and do a lot of, great hard work. And I think we had a couple year period there in 2020 and 2021 where all of a sudden, they would go home for the holidays and, their parents were excited to talk about their job and what they did. And it was, it felt really great. And then I think in 22 and 23, when you're waking up every day, reading articles about how you're going to go bankrupt, I think that's hard on a lot of people inside the company. All of a sudden they're going home for the holidays and they're having very different conversations. And to me, I think the fundamentals were always such that we absolutely, should have gotten to this place. And, if we do our job from here, we'll go a lot further. But I think when there's that much noise around anything, there's always a risk that the people part breaks down. And the team, didn't. They did an incredible job. They fought super hard. They stuck together, and I will be forever grateful for that because I think that was the only real risk that, in my opinion, at least, we were facing.
Mm-hmm. What does that look like on a very tactical basis when you say the team? At the end of the day, you're a big company, and your great messages to the company, which I'm sure there were many of them, can only go so far. What happens on a day-to-day basis when you go through such a tough period like this? How do you keep the train on the train tracks?
Well, I think the most important thing is, we launched in 2013 and, for 8 years, all the signals kind of pointed in the same direction, right? Everything was getting better. We told our story about why we thought we could build a business that was, great for our customers and great for us. And we were kind of continually always improving. And I think that made it really simple for people to believe that we were building something that mattered and that we were ultimately going to achieve kind of our goals of selling millions of cars and being the largest, most profitable automotive retailer, which is our goal. And I think then when you go into 22 and 23, all of a sudden you're getting crushed in the stock market, which we always ask people not to look at too much because that's a volatile thing and you kind of lose control if you allow yourself to be too influenced by what's happening in the outside world. But people are looking at it and then they're reading articles that are tough and saying super negative things about us. And I think, just trying to make sure that when that's happening, you're reminding everyone about, all the things that were true for 8 years before are probably still true today. And all the people that you gained respect for over the last 8 years and that you worked with every single day over the last 8 years, they're all the same people that are here, trying to get the same things done. And there are oftentimes in business history, businesses, especially businesses that are trying to do big things or or swinging at it really aggressively, they go through tough times. And, that was kind of our tough time, or at least it was the most publicly visible of our tough times. And I think when you just try to get that across to people that, we're going through a time that's important for us, but nothing is really different. What we're offering to customers is the same. The fundamentals are the same. The business we're building is powerful as long as we do a good job. You tell that story over and over again. And then I think you try to put together a plan that allows you to make sure that you're making progress a little bit every day. So people see that progress and get motivated by the progress and remember all those things that were true for the 8 years prior, and shut out the noise that they're reading about every single day. And I think, the team was very effective at that. I think, and people bought in. And then, once everyone buys in, it kind of becomes a little bit of us against the world, which is, I think, part of what motivates every startup. And so in my mind, having been through it, I think it's like a great thing that we've been through now, because I think we're a stronger company than we ever would have been otherwise. And I think in many ways, we were kind of reborn as a startup. Like we went back through a moment where no one believed in us. And that creates a different kind of bond, and a different kind of, energy and motivation. So anyway, I think it was something I never would wish on anyone ever. But once you're on the other side of it, I'm actually kind of, perversely glad it happened.
Mm-hmm. I worked with my dad for many years, and it's part of the car business, right? There's a lot of family businesses and sons and daughters. How's the relationship with your dad after all this?
I would say surprisingly unchanged. My dad, I'm very lucky in many ways. I think, my dad was an entrepreneur in the car business, but also in other businesses. And so he's been through his own, trials and tribulations. And so I think that was helpful, because you at least have stories that you can be told about, riding it out.
I also wonder, as you're going through this, right? Is there a person that was like a mentor to you, or a board member, a family member, your wife? I don't know who, but was there someone that you say they had a very big impact on you throughout this period and kind of helping you stay focused? Anyone like that come to mind?
Sure. I mean, I think I could talk about that for a long time. I mean, there's a lot of different ways to answer that. I think if I were to try to answer it in the way that I think is most important, because I think I could give some credit to, my dad, who we just talked about. I think I give some credit to the board. I think I give some credit to the people that I work with every day, beside me, and all around. I think, my biggest piece of advice for anyone who's going through something hard would be, try to keep your personal relationships as separate as you possibly can, because you need an outlet where things can feel normal. And I think, my extended family in general, I think, did a good job, where it's kind of like, all that's going on, they're reading the articles too, I'm sure, but they did a good enough job hiding that they were reading all the terrible articles from me that I wasn't aware of it. And so it meant, we could kind of hang out and be normal, and you got that little break. So I think that was enormously important, because I do think it wasn't that hard to get to the mental place of, we're going to ride this thing out, because I do think it just made too much sense. The business is a powerful business. We have a team that's too strong. Customers like it. There was no reason we weren't going to ultimately get across the line. But it was going to take a ton of work, and it took a ton of work in times that were difficult, and where the world was not saying great things about us. So you just kind of need to persevere through all that. And I think, having outlets in your life away from everything being about Carvana all the time is very helpful.
Sitting today, it's, about to be 2025. You've been doing this for well over a decade. What surprised you about the growth and trajectory of this business the most? You can tell me if this is true or not, but I obviously studied the hell out of your business in many different ways, and we'll talk about that shortly. Actually, I'll tell you a funny story. Do you remember the Shawspring report that came out on you in 2018?
I remember the name. I couldn't place the report, but I'm sure if you bring me up to speed, I'm sure it'll jog my memory.
Oh my goodness, dude! So this report,
if it's negative, can we hit something else?
No,
come on.
It's not negative. It's not negative.
Okay, good.
It's
Perfect. Let's spend time on it. Let's definitely spend time on it.
This was like a 100-page report that came out on you, that it detailed like every part of your business.
I do actually remember. And I know the investor too. I know the investor. He's a really smart guy, a very thoughtful person.
Yeah. So, through the grapevine, not through him, obviously, but through the grapevine, it hit my email, my desk. And man, did I study that thing. And I think that was in my life, that was a step function change. Because that was when I looked at online retailing in a whole different lens. I said, wow. And by the way, and vertical integration, which we'll talk a lot about that. That was when I said, okay, there's a science to this. And it helped me think bigger. Because this report, most people listening to this have not read this report, is just by now it's outdated somewhat, but it's just like a very meticulous breakdown of how the business works, the flywheel, right? Why we're sitting here today having this conversation to begin with. That was a big change in my life, in my time building Get a Car. Tell me, when you started, now taking you actually way back, because I'm curious, when you started Carvana, is it true that your vision stemmed from, hey, why are we landlocked for selling cars? Like, why does it have to be done this way? Why can't we grow beyond our borders here and sell virtually, right? Like, what was that original thesis? Is it true that that was part of that vision?
It is approximately. Here's what I would say. I would say, I think I know a little about your background as well. And I think much like you, I kind of grew up around the car business. When I was, 16 years old, I felt bad for myself because I had to sit in the, auto finance office and, make GL entries while my friends went to movies and hung out in the summer. But I always kind of had exposure to the business. And then I think as I got more and more of that exposure, I would just, I don't mean to speak negatively about, anyone, but I do think if we're just honest, the auto industry has a bit of a reputation for, being a tough and frictionful, consumer experience. And so I would always try to understand why that was. And I think, generally speaking, I would just ask lots of, questions trying to break down the process and why things worked the way they worked. And I think most of the answers tended to either be, that's just the way it's always been, or some version of it would be way too hard to do it any other way, or maybe it wouldn't make any economic sense. And I just think those answers didn't strike me as totally satisfying. And, kind of like a general, maybe nerdily conceptual view that I at least have is I think as the world evolves, people change, their preferences change, technology changes, and the best business solution to any given problem is oftentimes changing as technology is changing or consumer preferences are changing. And so I think, when I would look at auto and say, there's a million things that are changing all the time in everyone's business. But if you back up far enough at a very high level, automotive retail had been done in a very similar way for 75, 80 years. And it felt like technology had changed a lot and consumer preferences had changed a lot. And so wanted to try to find a way to, honestly, the root of it was, is there a way to reduce variable expenses such that you can make an experience where the customer can just click through it, where you don't have to have a person in between? Because I think part of what creates the stress for people is worrying that they're less educated than the person who's selling them the car, and that there's a lot of variable decisions that they can't make in a super educated way. And so was there a way that we could kind of, remove that stress from them and try to be super transparent, but put them in control? Because control itself is a pretty empowering thing, and let them get through it. And I think that was really the goal, was to address kind of the underlying customer angst that exists, at least for many customers when they're buying a car. And then I think that, the tool set that ended up, in our opinion, enabling that was trying to automate things and build an online experience. And then that had all these other great properties because it meant you could, store cars anywhere and deliver them everywhere. So you could give customers way more selection, and it kind of evolved from there. But I think the root of the vision was, how do we build a model where it's okay if we don't sell quite as many aftermarket products, but we give the customer complete control? Because if they're clicking through and they're in control, they're probably not going to buy as much, aftermarket product. But we can make a business where the economics works. And to do that, we felt like we had to build a completely different business. And so that was really the kind of root of it.
This episode is brought to you by Deal Now, the leading administrative and transactional platform for vehicle acquisition. If you're still taking photocopies of driver's licenses thinking you're not going to get scammed, or how about fumbling through payoffs, checking titles, and making your customers pick up a paper check, you got to stop that. Deal Now has all the tools you need on one platform to safely acquire a car in person or long distance, including identity verification, title checks, payoffs, electronic documents, and instant payment. Get early access by going to dealnow.com/CDG. Again, that's DEALNOW.com/CDG to sign up, or click the link in the show notes below. Talk to us post-recovery. How has your business model most meaningfully changed? Like, what were the most significant changes since you've recovered over the past 2 years that have, brought you to where you are today?
So I think the honestly, like the biggest change is kind of focus in two ways. One is what are the types of things we're focusing on, and then one is how many things are we focused on. And so I'll start with the types of things we're focused on. When you're starting a business and you, especially one like this where you're like, okay, we got to build, like an inventory management business. We've got to build a vehicle acquisition business. We've got to build a logistics business. We've got to build a retailing platform, a finance business. We've got so many things that we have to build. A lot of times the choices that you are making, and then you've got to expand it because it's a business that has a lot of fixed costs and requires scale to get to the variable costs that you think enable the customer experience that you're aiming for. I think you have a lot of choices where you're trading off efficiency for either building more of the machine or scaling the machine. And so, maybe you have some new scheduling opportunity where you feel like you could build a smarter scheduler that's going to help logistics save $50 per car. But if you're selling 1,000 cars and you build that, it's going to save you $50,000 a year, right? That's probably not going to change the answer for the business in the long run. So it's not a very high priority to put your effort into getting more efficient there. Your priority instead is going to be, let's build the capability so, consumers get a great experience, and then we'll fill the gaps with people that care. And it'll be a little less efficient than when you get all the way to the end, but at least you'll get the customer offering, you can get the wheel turning, and you can start kind of rolling down the hill. And so I think those were the types of decisions we made for a very long time, all the way through 2020 and 21. I think the good news is the business that we built had a lot of low-hanging fruit in it because we had made those sorts of decisions across every different part of the business for a very long period of time. And then we found ourselves in a time where it was very clear that we had to become capital independent. And so we had to make sure the business got to a place where it was generating enough cash where we didn't need to go to the market and ask for it because the market was making it very clear that it wasn't available to us at that time. We started focusing a lot on efficiencies. And so we went back through every part of the business and all those $50 decisions that we had, made over a long period of time that we didn't think were the right investment then, they suddenly became the right investment. And so I think the story that we would like to tell is that kind of the financial power of the business has been revealed by the fact that we've spent the last 2 years working really hard on it. But the underlying kind of fundamentals of the business, the way that it works, the customer experiences, the financials that were possible, that really hasn't changed that much. It's more been that we focused on getting to higher efficiency. And then I think the other thing that I think is hard for every entrepreneur, is certainly hard for me, is just focusing on fewer things in general. I think my mistake is to get excited about all the cool things we can do and try to do all of them at once. And I think definitely in 21, I think way more so than anyone else in the company, I was personally responsible for getting us overextended and trying to tackle too many things. And I think seeing the costs of that and then seeing the benefits of being forced to focus on fewer things in 22 and 23, you have to kind of gain an appreciation, maybe gain a little bit of patience to say, we're going to get to the same place, but we're going to do it more thoughtfully, one thing at a time, and we're going to make sure we're always making progress. I think that was a big difference that made us way more effective as well.
Mm-hmm. I always wondered, we were in this era of cheap capital, relatively speaking, and I always wondered why you didn't do more acquisitions, because you love vertical integration. And I want to talk about that too. I love vertical integration. I obviously built a vertically integrated business on a much smaller scale than yours. We'll talk about ADESA shortly as well, which is obviously you've made up for all the acquisitions that you maybe could have done. But was there any reason why you didn't do so many more acquisitions as you were building for a decade? I know you did make several, but any specific reason for that? Or are you kind of, just building for yourself, weren't seeking it out? What was it?
Well, maybe a whole series of reasons. I mean, I think generally when you do an acquisition, you have to do it with some form of capital. And the most common form, at a time like that would be equity capital. I think, right, wrong, or indifferent, my personal view at least always was that we were going to build something way bigger, than we were at any point in time. And so didn't love the idea of taking a ton of dilution. So that was part of it. But I think honestly, more importantly, I think the history of whether or not acquisitions make sense is very, very positive. The history of whether or not acquisitions work out is far less positive. And I think that's because reality is always a lot messier than the spreadsheet. It's always a lot harder. There's people, there's systems, there's process that you have to integrate. People on both sides of the acquisition tend to believe the way they've been doing things are the right way, and they honestly believe it. But so they're resistant to change. And so a lot of times acquisitions can be tough. And so I think, we always had much more of a, we'd rather build it with people that have been inside the company and been absorbed in this culture and attack problems the same way that we attack problems, was kind of the way that we approach things. And then I think ADESA was an incredibly unique opportunity. And I could talk about that for a long time. So maybe I'll pause here, but I'll just say, we're extremely happy with the way that has worked out, in terms of what it means from a business perspective, and also what it means from a strategic perspective, and the way that the teams have melded has been great. And so I think that's been a great one for us.
One thing that's specific to our business is you've grown this innovative auto retailer. And how have you balanced, this is an issue, by the way, I struggled with. Like, how did you balance hiring people with tribal industry knowledge versus bringing outsiders, right? Because I would say majority of your company, or at least from the outside, what you can see is outsiders at this point, or people that did not have prior automotive experience in some capacity, right? But at the end of the day, right, you're selling a car. So what has been sort of your philosophy as a CEO with these types of things, right? Like, is your product team only non-automotive because you want them to think completely differently, or blah, blah, blah? How do you think about this? By the way, Ernie, my solution was for operations, just hiring drive time people.
Okay, nice. That's nice and simple. I'm aware of some of those hires, by the way.
All right, so we're talking about hiring people from industry versus outside the industry. Like,
here's what I would say. I think industry knowledge is very valuable because it helps you to figure out where likely answers are very quickly. I think if you don't have any industry knowledge, you have to rediscover absolutely everything from scratch. And so I think that's hard. I think that industry knowledge is very unhelpful in the sense that it can constrain you and cause you to start to believe there's only one way to do everything. And if there was another way, it would have been done that way. And so I think on average, I think it's best if you're trying to build something different to have more people that don't have industry knowledge, and maybe significantly more people who don't have industry knowledge. But I think you have to have some people that do have industry knowledge so that you can kind of get in the right ballpark quickly, because otherwise it just takes you so long and you can spin forever trying to, reinvent the wheel over and over again. Would be generally how we've thought about it.
I think for anyone listening, just something fascinating to do is to just put Carvana in the Wayback Machine on the internet and just to see how you've evolved the product. I mean, there's so many learnings in there. You see how your homepage suddenly changed to this, to that. Suddenly you're promoting We Buy Your Car. Like, it really shows the evolution of the business in a way, and just a bunch of visuals. Another thing, I'm trying to put myself in your shoes, and I say, all right, we just went through this crazy time period. What if it happens again, right? We don't know where our world is going, or in our country, there's a lot of change. How do you, as a CEO, how do you hedge from that as much as possible? In other words, how do you future-proof your business? And there's two angles to this, but I want to start with like the macro, right? Do you think about this? Like, hey, I want to, if before this drawdown, we were investing 30% of our time in efficiencies. And today in a post growth at all cost world, I want to consistently invest 60% of our resources in efficiencies in case another, economic shock happens. How do you just think about, hedging those risks that, the macro risks specifically in the future?
I think your ability to absorb pain is, I think, a function of, first and foremost, it's what is the quality of your unit economics versus the rest of the industry. So if you're able to make, $1,000 more than the rest of the industry, what that means is, as long as the shock impacts you and everyone else the same way, if their profits go to zero, you still make 1,000, right? So, and it's, if you're in an industry where there's many other players that have, similar enough unit economics to where they're all going to feel pain at about the same time, that's very helpful, because unless the shock hits you in a way that is different than the way it hits everyone else, it's unlikely that they're going to be able to go that far below zero, right? It's not like we're competing in this industry with, Google and Amazon that have, tens of billions of dollars of cash, and so they can absorb big losses for a long time. That's just not the way the auto industry is set up. So I think, having very high quality unit economics, I think is extremely important. And then I think, cash is obviously very helpful. I think that, what was tough for us going through 22 and 23 is that we were at a place where, investors believed in the unit economics that we would have. And so they were financing it. And we believed that the bigger the machine was, the better it would be. And so we were running really fast to go, get to the scale where those unit economics would show up, be very powerful. And then we got hit by the shocks of car prices and interest rates, and some of our own doing as well. We, some of the pain of growing very fast for a long period of time, I think, showed up then, and that caused some problems for us. So we got hit with all that, but we didn't yet have the unit economics, and we might have had cash, but it was dwindling because we were losing money still as a company. So that was a very different spot. I think the most resilient, in my opinion, that you can be is you have to have an offering the customers love. You have to have unit economics that are strong, and then you want to have cash. And so I think trying to just continually deliver to customers great experiences and trying to continually get more efficient with our expenses, across the whole income statement. I think those are the things that we can do that are most powerful, and I think that's what we're working on now. But we still have big eyes for the future for sure. We're still going to work hard to grow fast.
I want to slightly push back on one thing you said there, and I'm curious to hear what you're going to say. One of the insecurities I always had running and growing an online auto retailer was the fact that I was simply an auto retailer. I did not have service department. I didn't have these other businesses that kind of rounded me out and provided some hedging in times of distress. And so have you ever considered going franchise or, acquiring franchises for simply the lease returns, the kind of recurring business of service? I mean, how do you think about that? Because you're right, your unit economics, and we'll talk about unit economics soon as well, are better than the majority of the industry. You're a vertically or more vertically integrated business, but you also, in a sense, are, operating with this one segment, which is used vehicles. So how do you think about that and hedging in an environment where, the majority of your competition has other lines of businesses as well that are impacting, their financials?
Yeah. Well, I mean, let's just because vertical integration has been the nerdy business topic du jour. So let's put it in the frame of that. I think one of the comments that I made during that previous rant was if the shock doesn't hit you in a way that's different from the way it hits everyone else, the places where you're exposed to it hitting you differently is if others have a business line that you don't have, right? And so I think our weakness as a business in that frame is that we don't have service. That's something that many traditional dealers have, and it's a very profitable business, and it works out great for them. I think our strength is in the vertical integration of the rest of the business. We've got a finance business, we've got a logistics business, we've got an auction business, we've got. This is a bit complicated, but having a large inventory changes the economics of what's available a little bit. If you're a dealer with 100 cars and there's a car that, only 1 out of 200 customers really likes, you could choose to put it on your lot, but it's going to take twice as long to turn. And so you're going to have to buy it, with a bigger margin expectation. If you have 20,000 cars and there's a car that, 1 out of 200 people is going to like, you can buy 100 of them and you still sell them just as fast as every other car. So there's some benefits to having a scaled inventory. There's many, this is an auto-centric audience. Forever, if anyone who's been in the auto business, you hear about wholesalers that, buy cars where they're cheap and ship them to where they're expensive, or, they go and they buy convertibles in the Midwest, in the winter, and they ship them down to California and they sell them. Our business sort of does that without us having to plan for it. Because if we have demand for convertibles in California, we're going to basically be looking across the whole country for where can we get convertibles for the best price. We're going to buy them. We're going to recondition them there. The customer in California is going to buy it, and we're going to ship it with our own shipping. So there's areas where I think we're relatively strong, and there's areas where we're relatively weak. But I do think service is an area where we're relatively weak. I think there's a number of ways that we could try to approach that in the future, but I think that's a fair comment.
Mm-hmm. Do you see yourself ever acquiring a service business, launching a service business, providing retail service to consumers?
I think part of your question was ever, and I think we'll never take anything off the table. I think in the near term, I think our general view of service is that there's more service capacity as defined by kind of service bays around the country than is necessary. There's lots of excess service bays that are being underutilized, and our asset is that we've got around 2.5 million customers driving around. And so probably in kind of the near term, the best thing that we can do is try to partner with service providers, dealers and otherwise, and send them customers, and then do it in a way where we're meaningful enough to them to where we can make sure that, they're held to an SLA where they're delivering great experience to our customers, and, we're meaningful enough to them to where it's exciting for them. So I think that's probably like an easier direction for us to go in the near term. But the road is long. We'll see.
In general, I have to ask this, but would you ever consider, and I like to say ever because, it keeps it long term, but would you ever consider making an acquisition of, a franchise dealer group or groups for the inventory and the other benefits that come along with that? Or is that just not something that's on the cards?
I mean, again, when you say ever's a long time. So I'm always going to be very careful to leave every possible door open.
Give us some of the secrets, Ernie. Come on, man.
Yeah, well, we're a public company. Like, the whole job is to be cagey. I think, so far we've put a lot of focus on used. It's a roughly 3 times as large market. I think there's no question that, the offering would work with new as well. But to date, we've put our focus on used.
One of the craziest things about the Car Dealership Guy platform is our direct access to literally thousands of dealership and automotive employees. So naturally, I often hear this question: CDG, can you use your network to help me fill an open role at my company? Well, now I can. Building on the success of my free industry job board, I'm proud to launch CDG Recruiting, a more hands-on, white-glove automotive recruiting service. Whether you're looking to fill roles in dealership management, C-suite, F&I, fixed ops, auto tech, SaaS, we take the hassle out of hiring by doing the heavy lifting for you. And here's the best part: we vet and screen thousands of candidates so you don't have to. And with our placement guarantee, hiring through CDG Recruiting is 100% worry-free. Our team has decades of experience and has successfully placed over 1,000 roles in the automotive industry. So if you're ready to find your next rockstar employee, try CDG Recruiting today by visiting cdgrecruiting.com or clicking the link in the show notes below. Again, that's cdgrecruiting.com. More on the used front. Does inventory pose a long-term concern to you? Is that something that you think about a lot? Again, you've gone really hard into buying cars off the street, meaning from consumers, and you've done a great job at it. Is that something that concerns you long term? And I'll tell you where I want to get with this, right? Do you see a world where you reignite the dealer marketplace, which you were offering? I know that was one of your ideas, which you pretty much let dealers sell their cars on your platform. It was another way of acquiring inventory at lower margins for you. It worked out for a time period. You then shut it off. But inventory in general, is that something that keeps you up at night? Does that concern you?
High level, not really, would be the answer. I mean, what I would say is I think it depends a little bit on, near term versus medium and long term. I think near term, you can always run into little bumps. And so, you want to make sure you've got diversified access to different inventory pools. You want to make sure that you're being smart about where you're buying inventory. And I think there's always challenges that you face, day to day, and always ways that you try to improve day to day as well. I think medium and long term, the way that we try to think about this market is that, there's approximately 270 million cars in the US, and they're all being driven by someone. And basically what happens is once every 6 years, customers kind of get bored of the car they're in and they want a different car. And then, there's this whole thing called the auto industry that sits there and takes the car from one person and it, bounces around, maybe goes to auction, goes to a different dealer, who knows, all the different kind of things that it goes through. But then ultimately it goes to another customer. And as dealers, we're sort of the thing in the middle that holds all that inventory while it's, in that state between one customer before it gets to the next customer. But the fundamentals are such that we as dealers aren't actually demand, right? Supply and demand is just consumers trading cars with each other. And so it's always out there. And so I think if you're delivering great experiences on the buy side and on the sell side, that supply and demand has to go somewhere. And the goal is to get as much of it as we can.
Tell me more about just how you think about hedging your business in general. I think, the vehicle margin is compressing, right? It's been compressed. I mean, there was, again, the blip with the pandemic and all that, but margins are compressing again. And, the vehicle, I would say, the used vehicle is becoming more commoditized. It's not commoditized. Then, of course, there's all the other outlier risks like, robo-taxis eating up the kind of entry-level market share and blah, blah, blah. But that's probably further out. How do you think about differentiating your business? Look, when I started building Get a Car in 2018, much after you, we built, just like you, we built a lot of the technology, right? We had 30 plus engineers and digital retailing. I mean, we did all these things in-house because we couldn't find software that was great and could really create the experience we wanted. And vertical integration for me was, again, like you said, it's a fancy way of me saying we're going to build more in-house so we can control the experience. Oh, and by the way, we'll have better margins because of that as well. How do you think about the fact that our industry has, improved, technology has improved, dealers have much more competitive software nowadays? By the time we started Get a Car, by the time we shut down Get a Car, we had quite a bit of technical debt of things that we had built where you could find some SaaS product on the market for $2,000 a month that was probably at parity with your product. So how do you think about that and staying differentiated in this industry today and moving forward?
I think differentiation and sort of competitive moats are more about doing lots of things in a row, I think, than about any single thing. And I think that the more complicated it is to do all those things in a row, as long as that complicated string of things is valuable to customers, I think that creates your moat. And I think the way that I would kind of reduce what I think we do is I think, we've built a pretty different supply chain, where cars are purchased and stored in totally different ways. And we've built very different operations to acquire those cars and transport those cars around and recondition those cars and get them to their next customer. And we've built a lot of technology that supports all those different operations. And I think that, e-commerce can superficially sound like it's a buy button and it's a click online. But I think even if you look at other industries, Amazon, for example, is an operational juggernaut, right? If you actually look at like the underlying ops of Amazon, it's an absolute juggernaut, and they've obviously done incredibly well in e-commerce. And I think that's because they've paired technology with a different business model and differentiated ops that are supported by that technology. I think if you look at companies that have kind of gone in between, I maybe won't name them, but there's a number of companies that have gone in between that have kind of built capabilities that are more directly aimed at an e-commerce experience, where they maybe have like warehousing in the back that they kind of handle a little bit separately, and they've got a pickup area at the front of the store, and they've got a checkout flow on their site that kind of like really handles like an omni-channel type experience. I think they've done pretty well. And then I think if you look at businesses that are just kind of slapping a buy button on top, I think generally speaking, that ends up kind of getting commoditized pretty quick. So I think what you want to do is you want to find a string of things that are very hard to do that customers value. And I think if it's both of those things, customers value it and it's very hard to do, then it's hard to replicate. And then I think, just like we talked about the way our business and every business evolves over time, you want to keep adding to that string. You want to keep making sure that all the different parts are getting better all the time. And so I think that'll be our goal forever.
All right. So you talked about this doing a string of things, which obviously improves margins. Just take a guess. This shouldn't be that difficult. What do you think was the number one question that the audience wanted me to ask you on this podcast? Do you have like any idea?
My guess is margins. My guess would be margins.
Of course, it's margins. Can we just nip this in the bud? Like, what? I'm not sure why this is such a like controversial topic of understanding it. We could talk about like people believing it and all that. That's a different thing. But like dealers respect you. If I had a sentiment tracker of dealers, like they respect you. I would tell you that 5 to 7 years ago, that was not. I don't want to say that wasn't the case, but I'm saying like dealers have gained a lot more respect from you. Right? You've proven yourself as a great operator at scale. And I think you've really earned it in a big way in the industry. But what's up with this margin thing? Like, can you break it down for us, right? What your last quarter, I want to say was your most recent quarter was $7,427 a car. Most of your comps are, thousands less than that, 45,000 in some cases. Can you break down the gross profit per unit to us?
Sure. Well, I think I'll try to do it quickly because I think we've kind of laid a lot of the foundations, but I think you just, said it pretty reasonably. So let's say, we were 7,400, 75, let's say we were 7,500 to make the numbers easy. Then let's say if, many other dealers in the industry were kind of 4,000 to 5,000, let's call that 4,500. You got kind of a $3,000 gap. Probably on the order of 500 of that is just ADESA, right? So now you're sitting there with a $2,500 gap. Then I think you've got, a very meaningful portion of that is that we're a vertically integrated finance company as well, right? So we're, you can sort of think about the reason we've built a finance company is because most customers, when they buy a car, they need financing. And most finance companies are not structured in a way where they can rapidly give customers answers across many different cars to provide a high quality e-commerce experience. So we felt like we had to build that. But then in building that, we also have access now to the finance profit pool. So you can kind of think about like, how much does a finance company earn per loan that they originate? And that ends up being, big money. Let's call it $1,000, $2,000, depending on the finance company, and sometimes more than that. So I think that's a big one. I think we buy more cars from our customers than most do. We buy more cars from customers than we sell. So there's a big business there.
Then you sell retail. Then we sell retail.
Correct. Yeah. So we're buying more cars. Most of the cars that we sell retail, we bought from customers, and then we're also selling many more cars at wholesale that we bought from customers. So we've got a big business of buying cars from customers. And then I think some of the things that we talked about earlier were kind of like some of the wholesale business is basically built into the combination of our large inventory and logistics. And having a large inventory lending itself to being able to get higher margins while still giving customers the same or better price. There's truth to that as well. So I think you start adding all those pieces up, and you can kind of start to tie it out pretty quick.
Mm-hmm. Okay, so if we had to just put it simply, right? This is not just buying the car and selling the car. It's the financing, it's the wholesale margin, it's kind of everything packed into one.
Yeah, exactly. Yeah, trade-in, ancillaries, and then logistics. Yeah, everything.
You've publicly stated that your goal is to sell 2+ million cars per year, or I would say millions at this point. Do you see any like material risks to your margins long term? Like, do all of these different components of the business hold up? Do they actually grow and expand over time? Do you hit $10,000 gross profit per unit, being the business that you are over time? How do you think about that long term?
I think, subject to risk is everything's always subject to risk. You always have to execute. I think when we kind of do the bottoms up math and look at, the margin available in different parts of the business, we think it all makes sense. And we think that it makes sense at the same time that we benchmark ourselves and our pricing that we offer customers to other retailers out there. And we're doing very well in that regard. Like, we're giving our customers a great deal, while achieving these margins. So we don't think there's anything that doesn't make sense. We also, I think pretty excitingly, we talked earlier about how we shifted our focus to trying to get more efficient in all these different areas that we hadn't invested in for many years before. I think when we look at the business today, we still think there are many of those areas left. So we still think there's a lot more efficiency to gain. And so we do think that, bigger, whether it's gross margins or lower SG&A, we think both are achievable. And I think, our plan from here and our hope, if we execute the right way, is that we'll go unlock that, but that we'll pass a very significant portion of that back to our customers to continue to make sure that they've got, the simplest and highest quality deal available. And so I think that's our goal. But of course, all that's always subject to risk. We got to execute.
This episode is brought to you by Effective. Hey, you know Comcast, right? Well, what if there's a way to use Comcast's first-party data insights to directly advertise your dealership to in-market audiences? And what if you could target those audiences based on their interests, income, even what kind of car they're looking for? With Effective, you can do exactly that. As part of Comcast, Effective uses their first-party data insights to reach in-market buyers across traditional TV and streaming. Get started today at EFFECTV.com/auto. Again, that's EFFECTV.com/auto, or click the link in the show notes below. So before we get into ADESA, lots of questions there. I would just say, what makes you really believe that you can hit, millions of cars per year or 2 million? And I say that, if you look at CarMax, even at the peak, I think 2022, they did like 900,000 plus cars. And, CarMax, the juggernaut, by the way, they have a phenomenal online car buying experience. Why are you different? Like, why do you believe that you can hit these, crazy milestones that no one has really hit in the car business before? What is it about your business, your vision, that will enable you to do that?
Yeah, well, first you brought up CarMax. I think, CarMax is a great business. We got a ton of respect for them. I think that's a business that, growing up and dreaming about Carvana, it was a business that I know I always looked up to and admired. So, they're great operators. We have a ton of respect. I think, what I would say is it's useful. This is one of those places where I think sometimes it's useful to step out of the auto industry. I think if you look at most other retail verticals, the largest player tends to have a 30, +% market share. The second largest player will be 20 or 15, give or take. In automotive, it's pretty different. The largest player's around 2. We're today around 1% market share. And then I think there's this, big question of like why is automotive so different than everything else? And I think probably the biggest fundamental reason. I mean, let me first give like the nerdy reason, and I'll try to make it like a little more accessible. I think the nerdy reason is, does the business get better as it gets bigger? Does it have economies of scale, or does it have diseconomies of scale? Does it get worse as it gets bigger? And I think auto, as historically operated, has had diseconomies of scale, and so I think that's why there's generally been less market concentration. I think the reason for that is that there's a lot of decisions being made, a lot of very complicated decisions being made in a very complex transaction, like at the actual point of transaction. So every rooftop, they're making their own decisions about vehicle price, they're making their own decisions about the trade-in value, about the interest rate. They're working with a third-party finance company to figure out what the right down payment, monthly payment, and interest rate is for the customer. So all those decisions are being made, and they're generally, it's not like a deterministic system that is just calculating those decisions. And so it's really hard then to have knowledge in every one of those places that is able to handle the full complexity of that transaction. And so it's really, really hard to build that business and scale it. Now, I think what we've tried to do, and we try to do it, our goal was not to build economies of scale. Our goal was to create a customer experience where they felt like they were in control. But to put them in control, it had to be click, 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 done. And that required that it was all deterministic. That required that you could calculate the answers to all these questions. What is their monthly payment? What is their interest rate? What is the price of the car? What is the trade-in worth? So all of that had to be done centrally. And that means that, at all of our delivery points, at all of our hubs out across the country, the people that we're hiring, our customer advocates, they get to focus on just making sure they give a great experience to customers, right? They're much more hospitality and much less sales. And it's a different kind of thing to have to scale. So, we think that the fundamentals of the business, the completely different supply chain, the different way that we approach, customers, the way that customers are in control, we think that those are the underlying reasons why you can achieve, market concentration that looks more like what you see in all the other retail verticals. Because I do think automotive is the outlier. It's, all the other verticals look a lot more like one another.
Oh yeah. I mean, in one of the most fragmented industries, period. And at this scale, it's, there's not much like it. Well, it's May 2022, and you announced a big acquisition, ADESA. I mean, I thought this was very, very smart, right? You were, again, taking some of that capital, putting it towards bricks.
You should have told our investors.
Well, you know what? Actually, before we get into that, because I had this question from before, but we didn't get to it. Did any investors surprise you? Or I would say, how many investors? What was it like when you went through all that acquisition stuff? Was there certain investors which really kind of, maybe supported you more than you expected, let you down? I have to imagine you kind of got to know some people's true faces and true colors at some of these moments.
Yeah, I mean, I would say,
by the way, my DMs, Ernie, my DMs during that time were flooded. With a bunch of whatever public, not the massive ones, but public company investors asking all these questions and and they didn't know who I was at the time. Even, by the way, some people thought I was you at some point. That was another funny story.
That would have been a good trick. That would have helped.
Yeah, but anyway, so yeah, I'm just curious. What was it like dealing with the investors and throughout that time and expectations and all that?
That was, I mean, listen, that was a tough time for everyone, and I think
translation, there were some and there were some good people.
No, but the root of the problem was us, right? The root of the problem wasn't them. So I think it wouldn't be fair for me to hold people to a standard of, you had to stand beside us that whole time. Because we did get, we were caught off sides, and we were running things very aggressively, and things did move against us, and they worked out differently than we thought. And so, that's not what investors are signing up for. So I don't think we can fairly blame them. My personal take, I think some may have overreacted, but I don't think we can blame them for that, right? They got to make their decisions, and we put them in a tough spot, and that's our fault. There were many, though, that did stick with us. And I won't name them, which will probably frustrate them. You know who you are.
Can you name one for us or not?
Well, am I going to put? I'm going to stay away from that because there's quite a few, and I would end up having a couple names. But what I'll say is,
it's like picking a favorite child.
And there's not, to be honest with you, there's not that many. Most people didn't stick around, but there's enough where I want to make sure I don't miss anyone. But so what I would say is, I think that was very much appreciated, and I will say it was helpful. It's helpful in those moments to have someone that stands next to you and says, hey, we're here and we believe in you, and we're going to keep fighting. I think there's nothing there's nothing you can do that will leave a more lasting impression than to tell someone you believe in them when everyone else doesn't. And so, to those that did, we thank you for it.
What prompted the ADESA acquisition? Take us into your, if I was a fly on the wall, what am I listening to? What am I hearing?
I think, we've always had big dreams for what we wanted to try to build, and we've always believed deeply in vertical integration. And I think both of those things really pushed you toward ADESA. I think, having access to an auction so that we could be a more efficient purchaser of cars for our customers, so that we would have access to many cars that would be at locations where we could ideally in the future state recondition them at the same spot. That was super valuable. Having deep relationships with many buyers and sellers in the industry, that was super valuable. So I think the core auction business itself was very exciting. And then I think having auto-zoned real estate across the country, if you want to build an e-commerce business, like people oftentimes don't see it or think about it, but Amazon has a tremendous real estate footprint. It takes a lot of real estate to build a scaled e-commerce business. And generally it's very different real estate than a retail business, or a traditional retail business, but it takes a lot of real estate. And so I think that was also a big part of it. And so we were extremely excited about it. We remain extremely excited about it. I think today I'm probably more excited about it than I was then. But I do think, in between, obviously there were people that were asking questions.
Would you say the acquisition has lived up to your expectations, exceeded your expectations? Where do you sort of put it on a scale?
I would say exceeded in a number of ways. I think, very importantly, when you do an acquisition between public companies, it's very kind of cloak and dagger, right? Like there's a negotiation that happens. Your diligence, like on the ground, it has to be very, very carefully done because you can't kind of give away what's going on. And so a lot of it is reliant on what you've kind of seen in the past and the people that interact with that business all the time. You can do a lot of financial diligence and legal diligence, but that's different than on the ground diligence and meeting all the people and forming relationships. And so I think, when you complete it, and now it's all of a sudden public and you get to kind of go around and meet everyone, it's really kind of the first time that you're forming, the relationships that are going to matter for actually building what you care about building over the next, 10, 20, whatever it is, years. And I think the people of ADESA were great and embraced us. And I was nervous that they would be anxious. And I think they really weren't. They were kind of excited by all of it. And so
I'm actually surprised by that. I feel like that was that was your first foray into like the traditional automotive space. And I sort of, no?
Well, no. I think as Carvana, certainly. I think, I felt like we kind of knew what we were getting into. But then I think what I was so excited by was just, honestly, of course, there was anxiety on the ADESA side, but there was a lot more excitement than I kind of imagined. And that was great. And then I think since then, we've learned a lot from them. I hope they feel like they've learned a lot from us. And I think we've integrated operations in really interesting ways. We're doing all kinds of things that I think have the ability to create a lot of value for us and for our both customers, both of our customers over time. And so I think it's fun. It's exciting.
How do you view dealers nowadays? Like, do you now that you own this, one of the largest auctions in the world, are dealers your competition? Are they your customer? How do you think about that?
I think they're both. We're just like anyone else. We want to play hard and win, right? But I also think they're absolutely our customers. And will be forever in the future. This is I think this is a very big industry with lots of players. And I think if you want to make a mark in the industry, you have to be able to maintain a bunch of long-term relationships with a bunch of people throughout the industry. I think, an example is, I think every company, you have to decide if you're in the same industry, you're eventually going to bump into each other to some degree. And you kind of have to decide, is there more to gain by working together, or am I worried that I'm going to help this other company if I work with them in a way that's going to ultimately harm me, and so I don't want to work with them? And I just think that in real life, rarely is the second thing the right choice, right? As we bought ADESA, we became, kind of direct competitors with Manheim, who's been a big partner of ours for a long time.
I was just saying about Cox Automotive. I was just saying about that because I know you've done. I was surprised when you did like a whole, when you started launching all the auction stuff, auction access or whatever. like, years ago. But yeah, that I was like, okay, Cox Automotive, Carvana, they're doing some things
Well,
together.
Cox has been great to us. I mean, honestly, we tested the first version of our website in one of the Auto Trader UX test rooms. So they've been great to us from the very beginning, and I hope that they value the relationship the same that we do. But we do compete, right? And that's okay. But while we compete, we buy cars from them all the time. There's a bunch of great cars at ADESA, there's a bunch of great cars at other third party auctions. There's a bunch of great cars at Manheim, and we want to have access to all the cars. We sell cars through them. We sell many cars through ADESA. We sell many cars through the digital auction product that we're working on with ADESA today. But there's also markets where we haven't launched that product yet, and it's early days, and where Manheim has a really vibrant market, and we sell cars there. And I think that'll be the same for a long time. So I think it's the reality of being ambitious in a big industry is I think you're going to have a lot of relationships where you're partially customers and you're partially competitors. And I think that's the reality of where we find ourselves today.
Mm-hmm. Other people in the dealer community, they think that, okay, Carvana is just going to turn ADESA into a parking lot for its inventory, right? If we look 5 years into the future,
that's not the plan.
So what is the plan for that? Is it going to be a parking lot, or is it going to continue operating and thriving? Like, what's your plan for the business?
No, yeah, we absolutely want both of those things that we sought out at the beginning to be more deeply vertically integrated, which means running a vibrant auction. And we want to benefit from that huge footprint, right? And I think that's what these mega sites are about, which are obviously labeled in a somewhat fun juvenile way as mega sites, but those are the sites where we're adding Carvana reconditioning capabilities to ADESA sites, and I think that enables us to have both. We're investing today in a product we're super excited about called ADESA Clear, and that's basically our kind of digital auction product where today we, Carvana, are the only seller on that product, and we're rolling that out market by market. The reason we're the only seller is we believe that to build the highest quality, best functioning digital auction the fastest, one, we want to be able to focus on one side of the market, so we're able to focus a lot more on buy tools instead of buy tools and sell tools at the same time. And two, we're able to ensure that there's behaviors on the market that are long-term optimal behaviors. I think as a seller, entering a marketplace, a lot of times your incentives may be to set floors really high and to not sell the car, and you can kind of create marketplaces that have really low sell-through rates and have kind of worse properties. And the goal is because you want to get the most proceeds you possibly can. But if you're willing to invest in constantly having behaviors that are good, that cause buyers to want to come back and buy in that marketplace, then you can build a better marketplace over time that's more efficient for everyone. And so we're trying to invest in using our cars to make that marketplace both technologically really exciting, but also behaviorally really exciting. And then over time, we'll probably start to make that available to other sellers as well. But I think we're absolutely investing in the auction business, and we're absolutely investing in reconditioning capabilities to take advantage of that huge valuable footprint.
Mm-hmm. Did anything about this acquisition really surprise you? Was there anything that you didn't expect?
Nothing meaningful. I think in real life, everything always is a little different than you expect, and it's a little harder than you expect, and that's always true. But nothing that would rise to the level of being meaningful.
Yeah. All right. So I want to shift before we wrap up here. This has been incredible. I want to talk a little bit about the future of Carvana, because you're a private company and we can say all the details, right? No, I'm just kidding. No, but in all seriousness, I want to talk about let's start with the car buying experience and AI and consumer behavior shifting. I mean, how do you see, what's your general take on AI in your operations, right? Where are you thinking with that lens the most? Is it, it will bring more efficiencies to our back office, this will meaningfully change how consumers buy a car, they'll just go to Carvana.com, right? I am a single mother aged 35, and exactly what she wants will pop up with the exact monthly payment. Like, what's your sort of vision with continuing to push your company forward with AI? Look, I'll tell you that even in my business today, it has just changed how we operate everything. I mean, the tools available, obviously, table stakes is like the large language models. I mean, ChatGPT and all that. But I just see the impact on a day-to-day basis. I see myself using it, and I'm very conscious of changes to consumer behavior. And I look at myself and say, okay, wait, I'm doing something differently, and that doesn't happen very often, right? There was the iPhone moment, there was some other moments, but this is real, and it's growing. How do you just start there? Like, what do you think of AI? How do you think of integrating it into your business?
I think it's extremely exciting, and I think it has the potential, and at this point is much more likely than not to impact. I mean, almost anything you can think of. I think almost anything that a person could do or could like add value to, or where personalization is valuable, I think can be improved with these tools. And I think the speed at which they're improving is faster than the speed at which almost any company is adopting the technology. So it's like amazing. The horizon of what's possible is like running away faster than people are even adopting it. So we have, in like our day-to-day lives, we have no idea really like how impactful this potentially could be. I mean, I think what we're doing today inside Carvana, there's like a number of different even types of AI and different applications. Maybe three that we could talk about. There's, and I'll end with kind of LLMs because I think that's an underlying technology that's very exciting. But I think one is just even code generation. We're beginning to work a lot more in trying to get more of our code to be written in ways that are basically automated. It's taking like a product requirements doc and turning it into code. And I think the more of your code that you have written inside the walls of your company, kind of the better off you are, because there's more ability for the for like the model to understand your syntax and your database naming conventions and everything else, and kind of write it in the ways that you call services, write it in ways that make sense. So I think we're starting to do some work there. And I think, the results early on are they massively impacting the business yet? No. Are they extremely exciting and pointing in directions that are almost like mind-boggling? I would say yes on that. There's some things in vehicle merchandising that we're looking at that I think are super interesting, more on the actual like physical photography and vehicle merchandising side that I think are super interesting. And I think the capabilities there are probably going to also move, very, very quickly. And then on the LLM side, I think, we've got, our like chatbot is Sebastian. Today we're putting a very disproportionate amount of our energy into kind of making sure that the brain that our chatbot has is as powerful as possible. So, to make the brain powerful, you want to be vertically integrated. So you've got access to all the different services it would want to call. You need to have the scheduler. You need to have financing terms. You need to have pricing and data on all the cars. So if a customer says, I want a car with a third row seat that can be delivered, by tomorrow, and my payment has to be less than $400, you want, a machine that can figure all that out at once, but it's got to call a bunch of services in sequence and be very organized about the way it does it. That requires a lot of preparation of, one, it requires you structuring your business in a way where you have all that data. Then it requires enough of that data to be able to make sense of it. And then it requires you kind of structuring it in a way so it's instantly accessible, and feeding it into the machine intelligently so that it can respond in ways that make sense. A ton of work there. So I think we're working a lot on that brain. And I think once we get the brain to a spot that we're really excited about, I think we'll start to play with more front ends, because I think there's a lot of different front ends you can put on it as well. The chat interface is one of many possible front ends. So anyway, I'm very excited about it. I don't think we yet know exactly how powerful it'll be. There's no question the technology is much more powerful than most people appreciate right now. And it's going to be fun to watch.
The nerds will love that answer.
Cool. Good. I hope you have a lot of nerds.
The year's 2035. What have you achieved? What has Carvana achieved? And what does Carvana look like? And give me if you can, provide like a very, as visual as you can, explain to us, what does the company look like by that point?
I'll tell you what I hope. I hope in 2035, we're a much, much bigger company. I hope we're a more profitable company. I hope we're giving customers an even better deal, because we've found a lot of these fundamental gains, and we've taken some for ourselves. We've passed most on to customers, and I hope that we feel the same way we feel today, where we feel like we're not even close to the end. Because I think that's kind of what makes it fun, right? What makes it fun is feeling like there's so much left to do. And I think if you've got a sufficiently creative group, I think that it's more likely than not that you're going to discover more things to do than you're, gonna ever get enough done to where there's not, more in front of you. But I hope that's what it looks like in 10 years. And I think we've got a good shot. So we'll, that's what we're going to try to make happen.
Well said. Ernie Garcia, much appreciated. Thanks for coming on. This was quite the conversation, and I've been looking forward to it for a long time. Appreciate it, man.
As have we. We'll appreciate you doing it.
Thank you.
Thank you.
All right. Hope you enjoyed that episode. Please give the podcast a rating, consider subscribing to the show, and check the show notes for links to what we talked about. Thanks for tuning in. I'll see you guys next time.